The first silver squeeze that we saw was not really much of a squeeze. You had a bunch of traders and young people who were trying to do what they did to AMC and GameStop, and that's not going to happen. I think that where you see a silver squeeze in all of this is the fact that you have 5 banks that have on COMEX alone are short between 7 and 800 million ounces of silver. And when I said metric tons, I'm sorry, I meant millions of ounces, 800 million ounces that India had purchased, not metric tons. I was thinking gold. And you're talking a whole year's worth of global mine supply by these 5 banks. I think that people will wake up and say, where the hell do I put my money? And bang, if a tiny, tiny fraction of all the money, if there was a 5, even a 2.5% allocation to gold across the whole financial matrix, you're talking a 5-fold increase in demand at 2.5%. Most financial advisors will say, fine, 5 or 10%. 10%, you're talking a 20-fold increase in demand. In 24 hours, everything's gone. And when you realize that, all this stuff comes from across the globe in an environment where people are freaking out, at what point do these mints around the world say, maybe we should not send it all to the United States. Maybe we should take care of our own people here or hold it back. Like, that's a possibility too, nationalization of some sort. So yeah, I've said forever, and again, it's one of these things, I say it and people think I'm full of shit because I'm talking my book, trying to, inject fear into the equation so they hurry up and buy, but it's just simple math and logic. Yes, I do think that will happen, and as God is my witness, I do. I've been saying it for years, and because I've seen most of my career, we get to this time of the year, right around now, where the mints run out of product, and they will not make any current year issue until the next year, 2025 in this case. And they say there's no bull market, Danny, like a metals bull market, because people look around and say, I'm not going back into dollars. I'm not, even if I have a healthy profit. Look, silver's up 40% on the year. Gold's up 35% on the year. Gold is, what was $1,200 an ounce 10 years ago. It's now 27 and change. You've way over doubled your money. If I call any of those people who bought from me 10 years ago and say, you want to capture that double? No, I'm not going back into dollars, they'd say. So it's different than most other bull markets. In fact, the higher the price goes or the scarier the world gets, or both, only reinforces people's motivation for owning it to begin with. So that's, one of these deals where, unlike normal markets with metals, the higher the price goes, the higher the demand goes. Usually when price goes higher, we see demand start to fall as a reflection. They say the cure for high prices are high prices, and the cure for low prices are low prices. But this is different. This is an environment where people say, as the price goes up, I was right, the world's falling apart, better buy more. It will be the defining characteristic of this market, where people just can't get it because so few people own it right now, and there's so much money out there. That the people that you and I talk to are the pimple on the elephant's back. The elephant has no idea. If the elephant turns around and says, my God, I need some gold now and some silver, it'll be gone in a matter of hours or a day or two from the major retailers, who then have to order more, most of it from across the globe.
Schectman begins with a compelling thought experiment. What would happen if even a small fraction of the financial market shifted to gold? If just 2.5% of the global financial matrix allocated to gold, the demand would skyrocket, causing a 5-fold increase overnight. This idea of a sudden surge in demand isn't as far-fetched as it may sound. As economic uncertainties grow, investors are increasingly looking for ways to hedge against inflation and currency devaluation. For many, gold and silver are the logical answer. In a world where traditional markets are volatile, advisors often recommend a 5 to 10% allocation in precious metals. At a 10% allocation, Schectman notes, demand would surge by 20 times, drastically outpacing available supply. This demand would not only strain the market, but also expose vulnerabilities in the supply chain. Precious metals are sourced globally, and a surge in demand during a period of economic instability could lead some nations to prioritize their own needs over exports. Nationalization or restrictions on exports could follow, meaning the US and other major consumers may find themselves competing with other nations to secure supply. Schectman highlights that this scenario isn't purely speculative. He's observed trends over his career where, around this time of year, mints worldwide begin running low on inventory. Once the current year's products are sold out, mints typically halt production until the following year. This recurring supply crunch suggests that, in a true bull market for metals, demand could quickly outstrip available stock. Unlike traditional bull markets, where demand might wane as prices rise, the demand for precious metals tends to increase in tandem with price, driven by investors' growing distrust of fiat currencies. To illustrate this, Schectman points to historical price gains in gold and silver. Gold, which was valued at around $1,200 per ounce a decade ago, is now over $2,700. Silver has seen similar gains. Yet, investors are not cashing out their holdings to realize profits. They view these metals as long-term stores of value. In fact, many of Schectman's clients have doubled their investment in gold over the years, but refuse to sell because they're unwilling to return to dollars or other fiat currencies. Unlike other assets, where higher prices can lead to a sell-off mentality, rising prices in metals reinforce investors' beliefs that they're making the right choice. This situation creates a unique dynamic. In most markets, high prices tend to dampen demand. But in precious metals, the opposite occurs. The higher the price, the stronger the demand. This trend is driven by a recognition that metals like gold and silver provide a hedge against inflation and financial instability. In a volatile world, investors view precious metals as essential to preserving wealth. So, what would a silver squeeze look like? Schectman explains that the silver squeeze we saw in 2021, driven by retail investors inspired by the GameStop short squeeze, was just a taste of what's possible. In reality, it would take more than retail investors to create a sustained impact on the silver market. Schectman points out that a true squeeze is more likely to originate from larger forces, such as foreign governments or major financial players. India, for example, has imported nearly 800 million ounces of silver in recent years. Meanwhile, 5 major banks have short positions on the COMEX exchange that amount to nearly a year's worth of global silver production. These positions expose them to significant risk, especially if silver prices rise. A relatively small price move, say $1 or $2 increase, can translate into billions in losses for banks with these large short positions. The existence of these short positions reveals a vulnerability in the market. If one of these banks were to exit its position suddenly, it could trigger a cascade effect, with others scrambling to cover their shorts as well. Schectman likens this scenario to a race for the exits, where the first bank to act may avoid catastrophic losses, but those that follow may face severe financial consequences. This type of squeeze would be driven by the bank's own self-preservation instincts, as they realize the untenable nature of their leveraged positions in a rising market. Foreign governments have indeed been taking advantage of Western price suppression to build up their reserves. By standing for delivery on futures contracts, these nations are steadily draining physical silver from Western vaults. Schectman notes that these countries understand the game being played and are using it to their advantage. As long as Western banks continue to suppress prices, nations like China and India can acquire metals at artificially low prices, steadily building a war chest of real, tangible assets.
You know, the first silver squeeze that we saw was not really much of a squeeze. You had a bunch of traders and young people who were trying to do what they did to AMC and GameStop, and that's not going to happen. I think that where you see a silver squeeze in all of this is the fact that you have 5 banks that have, on COMEX alone, are short between 7 and 800 million ounces of silver. And when I said metric tons, I'm sorry, I meant millions of ounces, 800 million ounces that India had purchased, not metric tons. I was thinking gold. And you're talking a whole year's worth of global mine supply by these 5 banks. On the LBMA, it's between 4 and 6 billion with a B ounces short. So yeah, I mean, this is a situation that I don't think ends well for one of these banks, where the squeeze happens, I think, when one of the banks breaks ranks. One of the banks says, "Listen, we can't keep letting our balance sheet bleed in this direction. So we're going to cover and get out." And if one of them breaks ranks, it's kind of every man for himself. That's when you see the price start to rise dramatically. But with 800 million ounces short just on COMEX, the $1.50 move we saw a week ago, you're talking what? $1.2, $1.3 billion loss in the span of a week. And that's why they're kind of trapped, these bullion banks who have created this short position, where on the LBMA, they're trading upwards ends of 2.9 billion ounces per day. That's 3.5 times annual global mine supply, where forever less than 0.25% of these contracts stood for delivery. Not the case anymore. So when 95% of these trades are paper trades, not backed by anything, it's naked. It's just because these bullion banks have the ability to play with the price. They have unlimited checkbooks. Well, that works against traders and hedge funds. It doesn't work so well against China, Russia, and India, who have the money to play whatever game they want with margin calls or dropping the price or rising premiums, lease rates, whatever it is, margin requirements, it doesn't matter. And they'll stand for delivery. And that's exactly what they're doing. So that's how you get a silver squeeze. It's not the silver squeeze where when you realize that the average allocation in this country is so paltry, less than 0.5% to 1% total of metals allocation across the board in the United States. Sure, it will add fuel to the fire, but the real possibility of silver squeeze are these other countries exploiting the delivery mechanism on COMEX and the LBMA. They know what we're doing. They've made repetitive statements about it in other commodities as well, like in grain, where one of the BRICS members says, we produce and consume more than the West does, but we have no ability to control the price. That's whether they're talking grain in this case, or they understand what it is with all of the world's commodities that are valued in dollars. So could there be a short squeeze? Yeah, absolutely. I don't think it will be at the hand of the trading public here in North America, but it will be more along the lines of a failure to deliver in London or on COMEX, where you see a cash settlement on COMEX, where in essence they have rules in place that protect the exchange, which is kind of another way of saying cash settlement or force majeure is a default. That's when things start to greatly accelerate. But these other countries have been using the suppression of the Western paper market against us. So they don't care that we've been suppressing the price. In fact, they're all for it. That's why they're not bitching about it, because it enables them to acquire things on the cheap. That will change in that environment, and it could. But
let's examine in further depth how a true silver squeeze, driven by sovereign nations and financial institutions, could unfold, and the implications this would have for investors. Schectman suggests that a genuine silver squeeze wouldn't stem from retail traders, as we saw with the 2021 movement. Instead, it would likely originate from larger, more influential players, sovereign nations, major financial institutions, or even central banks, all of whom are quietly preparing to secure their wealth in physical assets. Imagine a scenario where one of the 5 major banks currently shorting nearly 800 million ounces of silver on COMEX decides that maintaining such a large short position has become too risky. As silver prices rise, each price increase further deepens the bank's potential losses, making it more challenging to sustain its position. If one of these major players breaks ranks and begins to cover its short position, the remaining banks may find themselves in a race against time to exit as well. This every man for himself mentality could spark a frenzy, pushing silver prices up rapidly as each bank tries to avoid catastrophic losses. The ripple effects of such a squeeze would likely extend far beyond the banking sector. The LBMA and COMEX, the largest silver trading exchanges, have structured their markets around leveraged paper contracts rather than actual physical metal holdings. In these markets, an overwhelming 95% of silver trades are paper trades, meaning that most transactions are based on promises to deliver rather than physical inventory. If demand for physical silver suddenly spikes, these exchanges could face a liquidity crisis, potentially leading to cash settlements instead of physical deliveries. While this might protect the exchanges, it would almost certainly damage their credibility among investors who expected physical delivery. Schectman points out that this environment makes silver uniquely susceptible to a short squeeze that could surpass anything seen in recent history. Unlike other assets, where high prices can diminish demand, rising prices in silver and gold tend to reinforce demand. This phenomenon is rooted in investor psychology. As prices rise, they feel validated in their choice, interpreting price increases as confirmation that their concerns over fiat currency instability were justified. Instead of selling, they double down, further increasing demand. Now consider the impact of foreign nations, particularly those within the BRICS alliance, exploiting the vulnerabilities of Western markets. Countries like China and India have substantial reserves and growing industrial demand for silver, particularly in sectors like electronics, solar power, and medical devices. For these nations, silver isn't just a store of wealth, it's a strategic resource critical to their economic development. As they accumulate physical silver, they're steadily draining the limited supply held in Western vaults, effectively using Western price suppression to acquire precious metals at discounted rates. This trend among sovereign nations has been years in the making, and it's not limited to silver. BRICS nations have been expanding their gold reserves too, and they're increasingly open about their desire to reduce reliance on the US dollar. By moving toward physical assets, these countries are creating a buffer against currency devaluation, inflation, and economic sanctions. In this context, a silver squeeze becomes not just a financial event, but a geopolitical maneuver, as nations take control of essential resources and hedge against Western influence. For individual investors, these dynamics are a reminder that physical ownership of precious metals can provide a safeguard in uncertain times. The average US portfolio has less than 1% allocated to precious metals, which leaves ample room for growth if investors begin seeking alternatives to fiat currencies. Schectman suggests that increasing your allocation to metals now, before a potential squeeze, could help you lock in a stable store of value. As awareness of the fragility of the dollar-based system grows, even a small shift in asset allocation could trigger a massive increase in demand for gold and silver, pushing prices up significantly. A silver squeeze could also bring to light the structural weaknesses of the paper markets on which the price of silver is currently based. If cash settlements become necessary due to a lack of physical supply, it would serve as a wake-up call to investors worldwide. This scenario would highlight the difference between owning a physical asset and holding a paper contract, sparking a shift in investor preferences toward tangible metals. The force majeure, or cash settlement provisions that protect exchanges, would undermine confidence in paper markets, potentially accelerating a move toward physical ownership. For those seeking to protect their wealth, Schectman's analysis underscores the importance of a diversified approach that includes precious metals. Gold and silver have stood the test of time as stores of value. They are universally recognized, easily transferable, and not subject to the same inflationary pressures that affect fiat currency. As central banks continue to expand their balance sheets, the purchasing power of paper money erodes, making tangible assets more valuable. Silver's industrial demand further enhances its appeal. As an essential component in a variety of high-tech applications, silver's role in the global economy is secure, regardless of price fluctuations. Solar panels, for instance, rely on silver for its excellent conductive properties, and the transition toward renewable energy sources is likely to keep silver demand high for decades. This inelastic demand means that even as prices rise, industries will continue to need silver, creating a solid foundation of demand. Looking to the future, the dynamics in the silver market reveal a broader narrative about the stability of fiat currencies and the importance of physical assets. The BRICS alliance's accumulation of precious metals and their plans for an independent financial system suggest that we may be moving toward a multipolar world where commodities, rather than currencies, underpin global trade. While a full return to the gold standard is not imminent, the trend toward real, tangible assets is clear. Central banks around the world are increasing their gold reserves, and the public's interest in silver and gold continues to grow. For investors, Schectman's insights serve as both a caution and an opportunity. As the structural weaknesses in paper markets become more apparent, those who prepare early by securing physical metals may be better positioned to weather future financial disruptions. A silver squeeze, fueled by institutional and sovereign demand, could lead to unprecedented price movements. By understanding these trends and acting proactively, investors can secure a hedge against currency devaluation and potential market volatility. In conclusion, Schectman's analysis provides a strong case for holding precious metals in a diversified portfolio. Gold and silver aren't just commodities. They're historical stores of value with a track record of preserving wealth through economic upheavals. As global demand for physical assets grows and fiat currencies face increasing challenges, precious metals offer a tangible, resilient option. Thank you for joining us for this expanded analysis. As always, stay informed, stay prepared, and consider how precious metals might fit into your financial strategy. In a world of paper assets and digital transactions, tangible assets like gold and silver stand out as reliable stores of value. Those who recognize their worth and act accordingly are likely to be best positioned for whatever the future may hold.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.